If you're getting a mortgage, there's one question that could save you thousands of dollars, and almost nobody asks it the right way. Should you pay points or not? Because many lenders will push you towards a lower rate, but they don't always explain what it actually costs you to get there. So in this video, I'm going to break down points versus no points, which one actually saves you more money, and how to decide what's right for you. Hi, I'm Werner with Mortgage and Credit Pro. I'm licensed in Arizona, Oregon, and Washington. And I help buyers structure their loans so they don't overpay and so the numbers actually make sense over the long term. Let's break this down. When you hear the word points, what that really means is you're paying money up front to lower the interest rate. 1 point is typically 1% of your loan amount. So if you're borrowing $400,000, 1 point is $4,000 out of your pocket. Now here's the part that gets people. Yes, your rate will be lower if you pay points, but that does not automatically mean you're saving money because you have to earn that money back over time. That's called your break-even point. In most cases, it takes about 5 to 7 years to recoup the cost of paying points. So here's the real question you need to ask. Are you going to be in that loan long enough to break even? Because if you're not, you don't save money, you lose money. Now let's talk about the other side, no points. This means you're not paying up front to buy down the rate. Your rate might be slightly higher, but your out-of-pocket cost is lower. And more important, you keep your flexibility. And that matters right now. Because many buyers today are planning to refinance if rates improve. So if you pay no points now and refinance in 2 or 3 years, you never hit your break-even point. That's where most people get it wrong. They focus on the lowest rate rather than the total cost. Let me give you a simple example. I worked with a client who was offered a lower rate from another lender, but it came with points. When we ran the numbers, it would have taken them over 6 years to break even. Their plan was to refinance in a few years. So instead, we structured it with no points. Lower upfront costs, strong rate, and more flexibility. That's how you make the decision. Now let me say this, there are situations where paying points makes sense. If you know you're going to be in the home long term and keep that same loan for 5 to 7 years or more, then paying points can save you money over time. Also, if we ever get back into a lower rate environment and you plan to lock that loan in long term, that's another situation where it makes sense. But in today's market, with many people expecting to refinance at some point, no points is often a better strategy. Now here's the difference at Mortgage and Credit Pro. We don't just give you a rate. We break down both options side by side. Points versus no points. We can show you the numbers so you can see exactly what saves you more money based on your plan. We're also known for taking quotes from other lenders and beating them. That means better rate, lower cost, or both. And we close on time. If you want us to run numbers, reach out to us anytime and see how the different options affect your payment. If you want it done right, reach out and I'll break it down for you. And make sure to check out our Google reviews to see how we take care of clients. Now let me ask you something. Would you rather pay less up front or pay less over time? Drop upfront or long time in the comments. I read everyone. And if you need a great real estate agent, I can connect you with a great one. If this video helped you, subscribe, share it with someone who's looking at rates right now. And I'll see you in the next video.